It does take us to our talk of the tape. Can stocks stage an end-of-year run? Let's ask the Wharton professor of finance, Jeremy Siegel. He joins us now. Professor, it's always great to talk to you. We usually do this on Fridays, which affords us the ability to size up this week and the past few weeks at that. I mean, how does this market look to you here?
The market looks very, very solid. I'll tell you one thing. I don't think we can rely on seasonal predictions. We all said, September, October are normally weak months. November, normally the best month of the year, and it just squeaked out a little bit of a gain. December is usually a good month, but it can go either way. Actually, one of the most reliable periods for December is the trading days between Christmas and New Year's. That's up almost 90% of the time. So we could reach new records. I'm actually fairly pleased with what I'm seeing in terms of holiday sales. I was a little fearful that tariffs might impact those sales, but Black Friday was good. Cyber Monday was fairly good. Not gangbusters, but it shows an economy that, is moving at a, probably 2.5% GDP pace. One thing that's so unusual, Scott, yesterday when I saw jobless claims go to more than a 3-year low, and the day before that, on Wednesday, seeing the ADP employment report showing the lowest level in almost 3 years. That is something that is just never supposed to happen. The labor market is so hard to interpret. This is the most extreme no hire, no fire economy that we've ever seen.
It's funny, Professor, there are some notes today that do talk about seasonality being in our favor, as it tends to be, especially when you come into December with such a strong year leading into it. But there's also a mention today of FOMO, that it's in full swing yet again, that there are a lot of portfolio managers who have underperformed this market. Maybe they couldn't be as large as they otherwise would have wanted to in some of the mega caps. So now the chase is on. Is there something to that?
Well, there is, but again, the Mag 7 has been the outperformers, and they've been relatively weak, actually, over the last 4 to 6 weeks, which is a little bit surprising. Now, maybe some people will say, I've got to get them on my balance sheet in the last couple of weeks of the year. You do get some of that evening up that's happening, but I'm actually rather pleased to seeing the rally broaden out, and right now, I actually see less FOMO than I think I saw maybe 4 or 6 weeks ago.
Oh, interesting. The other idea is what Citi puts forth today, Professor, where they say no pain, no gain, and they use the A and the I in pain and gain in caps, and talking about a bubble. We think we're in a bubble in U.S. equities, they say, but bubbles are initially quite profitable, so stay long. This is like, well, I guess you have to inflate it before you pop it, so we might as well ride this as long as we can.
The biggest question I always get is this like the late 90s? And I said, well, just a minute. Is this like 96 or 99? There's a big difference about that. And by the way, that internet bubble was many times what we're seeing now. Not in both the tech stocks and the non-tech stocks. I'm actually pleased to see some caution in the Mag 7 recently. And I'm not saying, Tesla, Palantir, there's a few of them that do have those triple-digit PE ratios. But the others, PE ratios of 30 when you're growing 20% plus a year and beating on all metrics, I'm not saying they're the ones to own, but certainly I wouldn't say that they are in bubble territory. And once you subtract the Mag 7 or the related tech, you get PEs that are under 20, which in my, playbook is absolutely not a bubble. So I am not in agreement with, Citigroup's analysis here.